Hey guys, Jarrett White here with Whiteridge Mortgage, your mortgage advisor in BC. Today we're going to be talking about credit scores and unveiling the truth of what really is a credit score and how much does it actually matter. But before we get into it, if you wouldn't mind, please click that subscribe button, ring the bell, and like this video so I can continue to grow this channel and make more videos just like this to help people like yourself. It means more than you could ever imagine. So today we're going to specifically be looking at what not to do with credit. Therefore, you can always have the highest score possible and qualify for all the best products these lenders have to offer. We're also going to dive into what actually makes up your credit score and how much of each aspect takes up of that total score. And we'll go into them in depth later in the video. So the first thing I wanted to cover is credit card hacking. Now, there's many different terms for this, and this is basically when you're applying for credit cards to get those free points, maybe those air miles, to get the benefits from the sign up. Now, you really do not want to do this, and here's why. There's a couple different reasons. The main reason is anytime you're applying for new credit, that's a new inquiry, and that could potentially hurt your credit score. So if you're going around getting all these new cards just for the points, you could be potentially destroying your score by all the constant inquiries that you're taking on. Now, number two, it depends on you as a person, but if you have all this credit available to use, statistically speaking, you are more likely to use it and spend more money if it's available to you. Now, the next thing I want to cover before I get into what actually makes up your credit score is those free credit check companies such as Credit Karma. Are they accurate? No. Now, typically speaking, if someone is giving something to you for free, they're trying to use that as an avenue to get you through to paid services down the road. A lot of the time, those free credit check companies are trying to use that as an avenue to get you to get their credit cards or loans down the road, which typically have way more premiums than what you would get just at your typical bank. Stay away from them. They're not even accurate. There's really no point in using them. Now, for someone that does want to stay on top of their credit, there's two places you can go. You can go to TransUnion or Equifax. I recommend Equifax because most lenders, in Canada at least, are going to look at your Equifax report and not your TransUnion report. And in fact, both these different companies are going to have different numbers for what your credit score is. The reason why is they both have different algorithms. Now, I know Equifax and TransUnion are a paid service, but it's not that expensive, and it's much better to get the proper information and actually have plans in place, because I believe Equifax actually gives you ways to improve your credit. They give you recommendations. That's a lot better than looking at an app like Credit Karma, which is going to give you false information right from the get-go and really is just trying to get you through the door to sell you something else down the road. Okay, so let's dive into what actually makes up that credit score. First of all, you got your payment history. Next up is your utilization. Then it's your credit history as a whole. Then it's your public records. And then it's your inquiries. So those are the 5 things that make up your credit score, and each of them have different values to them. Let's dive into them a little bit deeper. So payment history makes up approximately 35% of your entire score, and this is based on your missed payments or if you're making payments on time. You always want to be making your payments on time, and when you look at a credit bureau, it's either going to show an I-1 or an R-1. That means you've made your payments on time. Now, an I represents installments, R represents revolving. So an installment loan would be something like a car loan where you're paying it down over time, whereas a revolving loan would be something like a credit card where you're making that minimum payment and it's just constantly revolving. Now, if you're looking at the credit bureau and you're seeing an I-1 and an R-1, that's a good sign. That means you've paid it on time. Now, if you see a 2, that's a bad sign. That means not only have you missed the due date, you've missed it by more than 30 days, and then it reports an R2, and that can definitely hurt your credit quite a bit. Now, it doesn't stop there at an R2, it goes R3, R4, R5, R6, and typically once it gets to about an R6, which is 180 days past when that payment was due, they're gonna go to collections and get them to start coming after your stuff, like you see in all the movies. So the single most important thing you can do is make your payments on time. I'm gonna say that one more time. Make your payments on time. Now, even if you're dealing with someone like a credit card company that is charging you too much, and maybe they are charging you too much, the best thing you can do is make that payment and dispute it afterwards. Because they don't care about you, they will trigger missed payments and they will destroy your credit, and chances are you're not gonna have a good chance of getting that removed from your report. So next up is utilization. This makes up about 30% of your entire score and is the next biggest piece of the pie. Now, what is utilization? It's how much of your total limit you're actually utilizing, meaning how much you're using. So typically, lenders want to see low utilization because if you have high utilization, that means statistically speaking, you're more likely to run out of room and need more credit or stop making your payments. Therefore, if you have high utilization right now, there's two things you can do to play with these numbers and fix them. Obviously, number one would just be simply paying down your loans. If you have the option to pay down your loans, I highly recommend you do so because having less than 30% utilization is going to make a big difference in your score than if you're maxed out at 80 to 100%. Now, the second trick that you have to be very careful with but can work wonders is increasing your credit limit. Now, obviously, you can probably tell that's a very dangerous thing to do if you're not good with your money. Because if you're already maxing out your current limit, chances are if you increase that limit, you're going to max it out again. But what I mean by increasing the limit is if you have a $2,000 credit limit and you're using $1,000 a month out of it, that's a 50% utilization. Whereas if you just increase that to a $3,000 or $4,000, well, now it's less than 25%. So having a higher limit makes it easier to stay under that low utilization. But there's a caveat to that. Because if you already have your cards maxed out, making a new inquiry could potentially hurt your credit even more and do more harm than good. And the reason why is Equifax is looking at that as if you've already maxed out your current cards and now you're needing more. So if this is something you're going to consider, be sure you're very careful with how you go about it. The best thing you can do is simply just pay down those loans. Number 3 was credit history. This makes up about 15% of your total score. And this is really the history of how long you've had that card. I have people all the time that ask me, should I go cancel that card that I've had for 20 years but I just rarely use it? No. It's best to just keep all your cards open. As long as there's no fees associated with it, it doesn't hurt to keep them open. What does hurt is to close it because it's closing off all that history you've built up over time within that line. So whatever you do, do not close your credit cards unless you absolutely have to, especially if they're ones that you've had for a long time. Now, number 4 is public records, and this makes up about 10%, and this is basically what the lenders have reported about you. Now, the two most common things you're gonna see in this section that could really destroy your credit is 1, bankruptcies, 2, consumer proposals. Oftentimes, consumer proposals, they tell you that it's not as bad as bankruptcy. They treat it exactly the same, especially when it comes to getting a mortgage. And you're likely not going to be able to get a mortgage with any lender, especially on the A side, with a bankruptcy or a consumer proposal on your report. And the only way to get rid of this is with time. And it's going to take 7 years for that to clear off. Same thing with missed payments. That's a 7-year timeline until those go away. But as soon as you have a consumer proposal or a bankruptcy or a debt owing that's showing as an R9, you're pretty much screwed for the next 7 years, unless you're okay with going with B lending, which is another form of lending here in Canada. It's really just the big banks. They have an alternative side to them, and that alternative side charges a higher fee with higher rates, and you also are required to put 20% down, even just to access them. And last is your inquiries, which makes up the rest of your credit score. This is the most misunderstood part of all of it because people seem to think that if they go to one bank to ask about a mortgage and then one broker to ask about a mortgage, it's going to destroy their credit score. No, it will not. And I know I told you earlier that inquiries can hurt your credit score, but it depends on who's pulling it and the reason for it being pulled. Every bank and every broker has their own pull codes through Equifax, and they're smart enough to know the purpose of why we're pulling that credit report. So in the purpose of getting credit cards when you're applying for new credit, they're going to treat every single pull as a new pull, and that will hurt your score. However, if you're shopping around for a mortgage, Equifax knows that you have the right to shop around and that you likely will be shopping around because you want to make sure you're getting the best deal. Now, luckily enough, as a mortgage broker, that's what I do for you is we have access to all the banks. We take one credit pull, we look at all the banks, and we find you the best deal and we explain which product might be suiting you best. However, hypothetically speaking, say you were to come to me and I was to pull your credit and then you were to go to the bank and pull the credit for the same purpose, which is getting a mortgage, they would treat that as the same pull and it would not hurt your credit score. And typically when inquiries are hurting your credit score, it's not by a drastic amount. Your score is not going from an 850 down to a 750 or a 750 down to a 700. It's usually just a couple points. Now, if you're doing it consistently, like you're shopping from car dealership to car dealership, applying for auto loans, yes, that could really hurt it over time. The first pull is not going to do much, but then if you keep doing them, a couple points each time adds up. So now that we've gone over what actually makes up your credit score, well, what actually is a good credit score? Because you're going to be surprised. A credit score ranges from 300 to 900. If you have anything below 550, you don't really have many options with any kind of mortgage. You may still be able to get approved for other loans like credit cards, line of credits, but chances are you're gonna have a hard time getting a mortgage. It would have to be on the B side, and even then it would still be tough. Most of you, if you've been making your payments on time, you don't have any missed payments, you have pretty decent utilization, and everything else checks out, no bankruptcies, no consumer proposals, chances are you're sitting higher than 700. 800 or 900 is exceptional credit. Even 680 plus is considered very good. And when it comes to mortgages, you're not actually going to get any better of a product for being in the 800s than someone right at 685. So if you want to get the best offers out there, all you really have to have is 680 and more. Now, there's people that brag about their credit score being higher than 800. That doesn't actually mean too much, because someone in the 700s is getting the exact same deal. And if your credit score is in the 800s, what that does mean is you may be more likely to get an exception from the lender. So having a credit score in the 800s is amazing, but when it comes to getting the best rates and best products, you're gonna get the same products that someone with 680 plus is gonna get. Now, 620 to 680 is pretty much your cutoff for A lending. You need to be at least above 620. There's a lot of major banks that stop at 620, like Scotiabank and TD. So there are banks that will go as low as 620, but there's gonna need to be reasons on why you're as low, and they're gonna look into you in a little bit more detail and see why your credit score is actually where it's at. Because they don't just look at the credit score, they look at the history, they look at the utilization, they look at the public records, and they make the decision based on that. But typically, if your credit score is 680 and above, all those other things are pretty decent to begin with. Now, anything lower than 620, you're likely going to be looking at alternative lending, which is that B lending I talked to you about, with higher rates and fees involved. So I'd say the three biggest things you can do to improve your credit is make sure that you're making your payments on time, you have low utilization, and you're avoiding any unnecessary credit applications, because if you don't need more credit, there's no point in applying for more. Well, there you have it. We dove into the truth about credit reports and credit scores. Now, if you found this video valuable, I'm asking a small favor, and all that is to click the subscribe button, click like, and ring the bell for notifications. It's really gonna help me support this channel and grow it, so that way I can provide more content just like this to educate you guys on mortgages here in Canada. If you're looking to talk about your own mortgage, look in the description, there's a link to book a call. I'm more than happy to help. I'm based in BC specifically, but I can work in BC, Alberta, Ontario, and Nova Scotia, so I'm more than happy to help look at your situation and see if there's anything we can do. Thanks a lot, guys. Catch you on the next one.